Welcome back to the Uplevel Dairy Podcast. And since our last monthly market update from HighGround Dairy, there have been some significant movements that have tightened margins. Yet beef revenue continues to be the saving grace through the end of 2025 and into 2026. And today you will hear how to put some strategy around your response to these three core areas of milk, feed, and beef from our correspondent, Curtis Bosma with HighGround Dairy. Information shared in this podcast is for educational purposes and is not a solicitation to buy or sell commodities. Opinions expressed are current opinions as of September 17th, 2025 at 12 p.m. Central Standard Time, and only represent the views of the speaker and not those of HighGround Trading unless otherwise expressly noted. This episode is brought to you by HighGround Dairy. HighGround Dairy provides global dairy market intelligence, insurance services, futures and options brokerage, and advisory programs to a diverse range of dairy market participants throughout the supply chain. Curtis, welcome back to Uplevel Dairy Podcast with your monthly market report from HighGround Dairy. And things have changed since we chatted last month. The market has been moving. What's been going on?
Yeah, there's been a lot of activity here over the last month. I know last month's episode, we talked a lot about things that were kind of sensitive areas. There was some fragility in the markets and some concerns that we may start to see prices rolling over. And we often talk about these dairy markets have this weird tendency of taking the stairs to the top and the elevator to the bottom. It looks like somebody pushed the elevator button here within the last month, and we have swiftly moved lower for both Class 3 and Class 4 futures for the foreseeable future. So looking at the fourth quarter of this year, Class 3 futures have lost about $1.50 a hundredweight over the last month, whereas Class 4 has almost lost $3 a hundredweight over the last month. Those two have traded places now to where Class 3 is holding a premium to Class 4. So for certain regions where pooling dynamics may come into play, that is an important thing to be mindful of there. But yeah, overall, been a big move that's been affecting margins and margin outlooks really for the next couple of months and quarters.
Do you want to walk us through each specific market area and what you're seeing for those movements and what you believe is making them move so much?
The overwhelming pressure behind what's really driving this market right now is when you look at the overall balance sheet of demand for dairy products out of the U.S. and both for exports as well, we're doing quite well. We have pretty solid domestic demand. We've been able to keep things in check with good exports as well. The year of 2025, when we wrap up this whole calendar year, will undoubtedly be a record year for cheese exports, but it will also undoubtedly be a record year for cheese production. So it is constantly in this price discovery process of how markets are functioning. We're always trying to find that equilibrium between supply and demand. Think back to your first day on your economics classes that you took there. You probably drew lots of supply and demand curves in those classes. And I think we're in a classic situation right now where supply is just simply outpacing demand. We're ramping up production in a way that the market did not expect. We talked about this, how over the last year and a half, when we look at the value of replacement animals going into dairy herds and you're seeing these $4,000+ replacements, it's easy to say, hey, we don't have the heifer inventory and we don't really necessarily have the ability to grow milk supply. But I think there was a lot of planned expansion that was taking place. We're also seeing a lot of herds holding on to older cows, so that overall, I would say a simple way of describing that is the herd turnover has slowed down, where people are keeping older cows in the herds longer, particularly when you look at the beef market and the ability to get $12, $13, $14, even $1,500 for a day-old calf. If you have one of those older cows in the herd that's maybe not producing very efficiently, but they have a $1,500 calf in them, you'll keep them around a little bit longer because there is still value in those animals. And that's something that never really had a situation like this over at least the last handful of market cycles, where the herd turnover rate has slowed down so much and people have been holding on to animals. And that's been affecting milk supply. We see it not only in milk production. When we look at milk production reports from this last one, we had huge growth in all those big areas we talked about: Texas, South Dakota, Idaho, Kansas. All those regions are blowing and going, but also from a milk composition standpoint. Again, got to give credit to those in the genetic space, nutritionists out there. Everybody's doing what they're supposed to be doing to get the most milk and most components out of these cows. But I think the market did not necessarily see this much of an aggressive push. A lot of people have been referring to it as the never-ending spring flush, where through July and August we've had strong gains in milk production that just persist, and strong gains in milk composition as well.
As you said, it definitely stands as something that represents all of these efforts, that genetics, nutrition, and really good management. But also, usually we see that flush in the springtime, but that hasn't been the subsiding that normally you'd see, especially as we get into those summer months. So that keeps that production level still strong, but in components as well, huh?
Yeah, absolutely. I mean, to all my friends I've run into over the last handful of weeks that are nutritionists that have said, hey, what's going on with milk futures? Why are we down so much? And my short answer is just, you guys are doing too good of a job. You're doing too good at this. We got to find a way to be less efficient. But of course, that's not the answer anybody wants to hear. So I think going back where the market expectation was that we weren't going to be able to really step on the gas from a production perspective, here we are making strong gains. And we'll even see, I think the next couple of milk production reports are going to show some kind of weird data, because we're starting to get into periods of the year where we had more influence in certain regions for bird flu from 2024. So, I mean, don't be surprised when we eventually see a California milk production report for like November of 2025 that shows that milk production in the state is up like 13% year over year or something crazy like that, because we were down so much last year because of that swift impact of all the bird flu.
When those reports come out, it's less of an alarm in your mind and more of just a recorrection.
I think you just got to look at kind of trend line of where things are at. I mean, we're still rolling at 3.5% year over year growth, which is pretty aggressive considering where things are at. But yeah, I mean, with that, we've seen pretty large downward pressure on these markets. I think in particular, I mean, when you look at milk checks, the two big markets that we look at of the four commodities that make up majority of the value in most milk checks being cheese and butter. Cheese futures in the cash market, we had been staying in this $1.70, $1.80-ish range. And now we've seen some days where we've been close to low 160s into the 150s even. And I think just with the strength of additional production there, if we do start to see stocks building at an aggressive pace, then we're going to get ourselves in a situation where it's very likely that at some point in the first quarter of 2026, where we're looking at cheese that's in the $1.50-ish range. It's still September now, so seasonally, I think we're still in an okay position to not have the wheels fall off anytime soon. But as things soften up here, the futures market is starting to price in some of these pressures and declines that we're going to be seeing. On the butter side of things, it has been, again, just like we were saying earlier, the milk supply from a total pounds, but also just milk composition, all this extra butter fat that's showing up in the market, all the bypass fats, palm fats that have been making their way into rations have been making a good lasting impact. But it has been interesting having conversations, I think, with nutritionists on that as well, where at a certain price point when butter prices fall, because we basically went from a forward curve in futures last month when we were having this conversation where, you know, 240 to 260 seemed to be the price range that we were expecting for the foreseeable future, whereas now we're in that $2 to 220, maybe 230 when you go really far out there on the forward curve. And with those lower price points, it starts to become less economical to feed some of these bypass fats. So there's been a lot of people that have been crunching numbers on that, but it also is interesting because for a lot of our clients that have good coverage on that, effectively because of their positions, they have secured a higher butterfat value for their milk. They may not make those same changes in the rations because for them, they're effectively getting higher prices on their milk because of what they've secured. And they're very significantly ahead of the market at this point through the fourth quarter and even going out to the first 3 quarters of next year as well.
So Curtis, when you look at the changes and the trends you've seen in the last month since we talked last, we got to zoom out and really look at a global picture. What's happening on that international level that you really see impacting the milk check for dairy producers and these movements in the market?
We always look at these markets, particularly the ones that have a little bit of global influence. And I think right now, you're just looking at global milk supply among the 5 major exporting regions being the US, New Zealand, EU, Australia, and Argentina. I mean, all of them except for Australia at the current moment are in growth mode. So the fact that we have strong milk supply growth year over year in 4 out of the 5 regions that are key exporters is definitely kind of weighing on the markets a little bit. And we've been talking throughout this year, one of the driving forces for excess incremental demand for both cheese and butter has been the fact that U.S. prices have been at a discount to the rest of the world, which makes us more competitive from an export perspective. But we're starting to see some of those product prices for European and New Zealand region milk powders and products start to roll over a little bit. So we track closely. There is a futures market for European dairy products as well. So looking at butter futures and some of the other products that are traded there. Over the last handful of weeks, we started to see some increased sell-side pressure there, moving those contracts lower. And as those contracts move down, that also then weighs on our prices as well, because we have to maintain a certain amount of a discount to be able to pick up some of that export business. And so it creates another kind of pressure point to the downside that could accelerate things lower. So that's been something to be mindful of. I know a lot of dairy producers, it's difficult to think of our products as global products, but we do compete on a global stage, and particularly for milk powders like dry whey and non-fat dry milk, those have a very high correlation value to those international prices. And when something happens on the other side of the world, it's going to influence our milk checks here domestically.
So Curtis, pivoting away from our direct dairy market, the other market that every dairyman is looking at right now is the kettle market. And so what are the movements that you've seen going on in that space in the last month?
Yeah, it's been kind of a running joke of one of the things that we always tell new clients when we're trying to simplify how we look at a dairy farm and the dairy business in general is that a dairy farm is essentially a conversion facility where you're converting feed into milk with the byproduct of beef. But it seems like right now in the current economics, especially where milk prices have declined, that beef is no longer the byproduct. It has become a key revenue driver from a profitability perspective. And I think a lot of dairy farmers are starting to feel a little bit like, hey, we're just cattle ranchers that just so happen to get a little bit of milk every day too. And it's been kind of interesting because when the way that we have historically modeled for margins on farm, and when you look at some of the industry benchmarks for revenue that is not attributed to milk, I mean, it's something in that $1 to $1.50 a hundredweight is what we've seen historically for non-milk revenues on dairy farms. But when you look at these prices, particularly with the elevated price of feeder cattle and live cattle, and what that kind of translates to for beef on dairy cross calves, as well as cull cows, when you kind of back that out into an average dairy farm of how many calves they're producing, what their herd cull rate is, and things like that, and then you take some of that math and apply it to figure out on a per hundredweight basis right now, how much are we attributing that to the milk check? And it's in that $4 to $5 a hundredweight type range of additional revenue that's being received right now because of how elevated these beef prices are. So when we're talking about margins on a dairy farm, the way that we have our, like every Monday for subscribers to our email list, we send out a margin monitor where we can look at, based on the movements in both the milk markets and the feed markets and everything like that, what's going on, what does the future look like for the average dairy farm in the US. In that model, historically, we haven't really accounted that much for the beef side of it. We're actually revisiting that now. Within the next week, we should have this updated to include some beef revenue. But without those adjustments and looking at kind of the way our model currently stands, it looks like producers will be losing about $1 a hundredweight starting in Q4 of this year and going through Q2, almost Q3 of next year as well, because of the steep decline in milk revenue, essentially. But keeping in mind, if we're adding in another $4 to $5 a hundredweight of beef revenue, those $1 per hundredweight losses all of a sudden become gains. And I think that speaks to the importance of having a holistic approach to margin management when looking at milk, feed, and beef as sort of your 3 areas where you can have some semblance of control. And I know we've talked about this in previous episodes and talked about how the LRP program plays into this. If that's the only thing, these elevated calf prices that are keeping you profitable here for the next couple quarters, there are tools to be able to secure some of that revenue, because as it stands now, when we're going to update our model, it's going to go from a negative $1 a hundredweight because our current assumptions are only like $1.50 a hundredweight of additional revenue from non-milk stuff. If we add in the $4 to $5 a hundredweight of the beef revenue, well, all of a sudden we're back in the green again. But the only thing keeping us there is this additional beef revenue that's moving things forward a little bit. So from a margin management perspective, we've been staying on that with clients and making sure that we know, hey, for a lot of our clients that have been with us for a while, their milk positions are looking great right now. They're not necessarily concerned about milk prices going forward. But for people that are just getting started with this and are evaluating their options, it's pretty important to be watching these beef prices closely, because that could be the only thing keeping you in the black for the next couple quarters here. And that's able to be protected, and we want to make sure we're staying in front of that a little bit.
So the saving grace to the dairy farmer as we look ahead into 2026 and round out 2025 is certainly that beef revenue, but that's also not an insurance policy, is it?
No, and it's no guarantee that it stays there. We've seen feeder cattle futures make new record highs, but here over the last 2 weeks, we've kind of been stalling out, trading sideways a little bit. Conditions for herd regrowth in the U.S. are pretty spectacular with cheap feed costs. You have a lot less drought concerns, so the amount of available grass growth for cattle that are out there on pasture has been quite ample. So with all those conditions in play, a lot of the cow-calf operators, backgrounders will be retaining ownership of heifers, breeding back, doing everything they can to regrow this herd because of how high these prices are. Now, timing exactly when, going back to our supply and demand balances and stuff like that, timing exactly when the supply of feeder cattle will match or even exceed demand to cause some sort of a negative price swing in the futures market, that's a very difficult thing to time accurately. But when you take a step back and you think about your budget for your dairy in 2026 and where you're sitting financially, if you can look at that and say, hey, based on the number of calves we're going to sell, based on the number of cows we expect to cull, we've got an extra good chunk of revenue here that's sitting there. If we lose that, if that was to go down, if that feeder cattle market was to go from 360 to 260, what does that look like for us? And chances are that would wipe out a majority of the profitability for most dairies, because it's the last lifeline for people with no positions on right now. And another side of this too to add, I think we talked a lot about it from the margin management perspective of why it's important to cover this, but I also think it's important to think about this from how it's going to impact the milk supply as well, because typically when we move into periods in a market cycle where profitability, where margins get thin and profitability is not as good, we'll start to see people increasing cattle that they're culling, reducing milk cow herd size a little bit, and kind of adjusting to those market dynamics. And with the value of beef where it's at right now, I don't know that we're necessarily going to see that as aggressive as we would have seen in previous market cycles. If we're adding in an extra $4 to $5 a hundredweight of revenue onto the income statement and margins are thin on the milk side, but you're still getting that money back on the beef side, as long as these beef prices stay elevated, we're going to continue to see milk to stay in there, because that losses won't be felt in the cash flows at the farm level quite yet. So that's been another important thing to be mindful of, as people think, well, low prices will fix low prices on the milk side, but as long as we have high beef prices, those low prices aren't going to get fixed as quick as we want them to.
And Curtis, let's round out our conversation today on markets and what's been going on by taking a look at corn and some of our other grain commodities, because there have been reports starting to come in about what that looks like as we get into harvest season here. What are you seeing in that area?
Yeah, we are quickly approaching the harvest season here. From our last WASI report, so the August WASI report, we had the huge headline number where USDA added more acres for corn, but also gave us a 188.8 bushel per acre yield average. That obviously sent us to new contract lows. We had new crop corn trading below $4 per bushel briefly. We've kind of drifted up from there. And the reason behind that has been a couple things. We've seen a couple of private crop tours, so like the Pro Farmer Crop Tour has been suggesting that there were potentially smaller yields. So there was some doubts to that 188.8 number from USDA. So as that has been kind of scaled back a little bit, as different reports have been conflicting the actual yields, markets have been drifting away from those contract lows that were made shortly after that August WASDE report. And then last Friday, the September WASDE came out and they updated the yields. So we lowered them from the 188.8 down to 186.7. So that moves us down a little bit. We're still looking at one of the largest crops ever. So don't ignore that. But, that in mind, if we get out there in the fields and this continues to be shown as maybe not as spectacular, I would look for futures to continue to move up. Another thing to think about is just where we're at seasonally. So it's mid-September now. If we recall going back to when this crop was planted and we were talking about crop expectations back in March or April of this year, because of the trade tension, because of us talking about tariffs and such at the time, so many acres went to corn. And so with that was an easy headline number for all of the managed money. So think of the large sort of speculative funds that play in the markets. They built a very large short position, basically starting back in that time frame around planting, and weather has cooperated to bring those markets lower. And typically around this time, so late August, early September, we start to see those funds, if they have made a good position where they sold at a higher price point, because back then we were in the almost $5 per bushel type price range for those new crop corn futures. As those prices have come off, they have unrealized gains on those speculative positions, and they don't want to risk it at harvest time. So chances are there's a lot of liquidation of those large short positions, and those are hundreds of thousands of contracts that are in the corn futures market. So as those come in and as those bids kind of keep things stabilized, and if we are to see the yields kind of continue to get downgraded, I think that could mean that the low is in for the corn market at right now, but we're always open to surprises. So one thing we've been watching, particularly with clients out in the Western US, think of the rail markets where basis is much higher. We have started to see basis come off a little bit, which has made the new crop corn contracts look a bit more attractive. But futures are off the bottom. So I think a lot of people are still having sort of hesitations of saying, hey, I know that basis has gotten cheaper, but when I'm looking at this corn market, I wish the futures were still lower. Like, what happened to that $4 new crop? And to that, there are positions we can take. So we have been looking into that with clients where essentially you could go and lock up your cash position if you find the basis levels favorable, and then you could do stuff in the futures market to kind of keep yourself open on that price flexibility going forward, especially with the carry in this market where front months are trading at a 30-40 cent discount to some of the deferreds. Those are big numbers that you want to make sure you're not getting kind of hung up paying for the carry. But overall, I mean, again, take that step back, take a look at your budgets for 2026, and those numbers still look okay. We're kind of running out of options. Of the three things we can control, the milk one kind of got burnt. We're down there big time. For people that position well on that, great, you're ahead of the game. Now, on the feed side, we got some good prices out there, still historically very cheap feed, all things considered. And then on the beef side, we're still near record high levels. So of the three things, again, we've had good opportunities to lock in really solid margins this year, and we're running out of options a little bit. There are still some options available in terms of taking action to make sure that 2026 could still be a good year for most dairies.
As you just said, still some options to look at optimizing what's in the year ahead and also positioning for 2026. What's the biggest strategic move that you've seen dairy producers make as they prepare to do just that?
That's a really good question. So we collect a lot of data on our side for making sure clients know how they're positioned, things like that. And when we look across all of our clients, and we were actually doing this exercise here recently, and we say, okay, which of the ones have had the most success and which ones maybe don't have as optimal positions? The metric that actually makes the biggest difference when looking at all the data is when was the first action taken on any sort of coverage? Because the later you wait, if you're only covering yourself 3 months out or 4 months out, there's not much that can happen in the markets over a 3-month span. But for the people that are 9 to 12 months out, starting to layer in coverage, not saying that they're doing everything that far out. They may be doing a very small amount, but that is by and far the biggest differentiator of that. So I think you've probably heard me say this before, and I'll say it again, but being proactive and being consistent in this stuff is what really matters. You've heard me use the analogy of the vitamins and painkillers, where we try to get our clients in a situation where we're taking our vitamins on a regular basis so that we don't have to take painkillers. But there's certain scenarios where, you know what, hey, we didn't want to take action on something, and now we're kind of in a situation where we got to take some painkillers. And it's not our favorite thing to do. I would way rather play offense than defense, but sometimes that's just what the market gives you. I would say proactivity, consistency, that makes a world of a difference in these things.
And you have the data to prove that, as you said, looking at your own data sets of who really wins. And as you said, it's those that you see the trend to be most proactive and having done that advanced planning versus the last minute painkiller position. Well, hey, Curtis, thank you for catching us up to speed on what's been going on in dairy markets, commodity markets, cattle markets, and beyond here on the Uplevel Dairy Podcast. Anything else you want to add as we round out our monthly market update for September?
I think it's just kind of a call to action for any producer that's out there that may be listening to this and saying to yourself, hey, I feel like I might have missed the boat on this milk market. Just keep in mind that there are options. And I think one thing that we really, really strive to do for people is add that clarity to feel like you're back in control of what's going on. It can be difficult to do. It can be difficult. There's so many moving pieces to a dairy farm to be able to get that accurate projection of where things are at. But being able to have somebody on your side that can watch these markets and know how to position you appropriately and has the attributes that can take care of it. I mean, on our team, we constantly talk about this, where how do we be the best version of advisors? And it comes down to really 3 things that we talk about consistently. One is having the technical proficiency of knowing how to do the stuff within the markets of positioning and reacting to things in a quick and timely manner. Secondly is being a good communicator. So knowing, that, hey, there may be a lot of technical weird stuff that we follow that we have to be able to communicate to everyone, to all the stakeholders in the business and on the farm, so that they know what's going on when we're doing stuff or when we're advising them to do stuff. And then lastly is you have to have tenacity. You have to have a little bit of aggression to know when the market shows an opportunity to be able to step on it and get it done. I think a lot of times you see people that have 2 out of the 3 of those things, but finding all 3 and being able to do it dynamically is a bit of a challenge. I think the tenacity piece too is a very large portion of it, where if you have this paralysis by analysis where we're going to sit back and wait for the stars to align, we're going to miss a lot of opportunities. And that's something we don't like doing.
And for those folks that are looking to be able to position themselves strategically and take advantage of those things that you just talked about, we have all the links in the show notes to get in touch with you and your colleagues at HighGround, as well as your monthly market update that is downloadable for our listeners as well. So make sure to check out those links in the show notes. Well, Curtis, thanks for jumping in with us today, and we will see you back in a month in October.
Perfect. Thank you.
Well, that's all we have today here on the Uplevel Dairy Podcast. Make sure to check out those links in our show notes for more resources from Curtis Bosma and his colleagues at HighGround Dairy. I'm Peggy Coffeen, and thanks again for jumping in and joining us today on the Uplevel Dairy Podcast. If you like this episode, please take a moment to rate or review and let me know what you think. Peggy at upleveldairy.com. And until next time, keep on growing, keep on learning, and up-leveling your dairy.